on board Adrian Mowat to talk markets. He's we've interacted with him in different capacities, but each time I've interacted with him, the sense I've got from him is that he likes two things. He always loves Indian stocks and he loves Indian food. So Adrian, good to have you back. What should we start with? Indian food, your love for it, or Indian stocks, which you've always liked?
I think at the moment it might be better if we just focus on the food.
So the food for thought is it inflation? Is it valuation? What is the bother here?
So India's got a number of challenges on a relative basis. The market in India is very much a growth market. PE multiples tend to be high. Returns on the stocks historically have also been high, particularly return on equity. And the problem that we have in capital markets is we're in that derating cycle. So simply inflation is driving central banks, and the central banks are being driven to both put up discount rates, which will lower PE multiples, but also being driven in putting up interest rates to cause slower growth. And those are painful things. And even though that may not directly impact India in terms of what the Federal Reserve is doing or the ECB is doing, you will get a relative valuation story. So if we look at what's happened within the market, more expensive tech names have perhaps underperformed this year. The favored stocks have been the ones where you've seen more of a PE derating. Now, on a macroeconomic fund, perhaps India's inflation rate at 7% is less shocking relative to Indian inflation history than perhaps some of the inflation numbers we've been seeing coming out of the United States, above 8%. But I do think we've always got to be conscious in India that India is an importer of energy. The move that we've seen on the oil price has an adverse effect on India, pushing up the current account deficit, perhaps at a time where demand for Indian services might be weakening. And the combination of that is playing out to some extent in a rupee that seems to be approaching the 80 level. And I think it is notable that the depreciation has accelerated in the rupee over the last month or so. I think these factors are in place that are going to make investors perhaps a bit cautious on the Indian market. Within EM, it's worth highlighting that we had the Chinese PMI numbers out today. The PMI for services surprised very positively on the upside. And some of the new order data out of the PMIs for China were also positive. And what we seem to be seeing within emerging market funds is a rotation into Chinese equities, which have been significant underperformers since very early 2021. And so again, in an environment where we're generally seeing outflows from pooled vehicles, within those pooled vehicles, we're also seeing a rotation into China, the biggest market in EM, and that will put pressure on other emerging markets.
Adrian, you've been saying for some time now that and you've been saying it, I think, since Feb, March, this is the time to do your homework and prepare for the next bull market. Are you done with your homework? How are you preparing for the next bull run?
Yeah, so the answer is I'm still doing a lot of homework, and it's quite a difficult environment at the moment. So we have high levels of inflation, and at some point, some companies might be winners out of that. There's probably more losers. So near term, looking at the margin outlook for corporations, it still looks extremely challenging. And in what is a bit of clearly is a bear market, bad news tends to get punished very hard. Where I think there are opportunities, if we look in, say, the developed markets, stocks like an Amazon, which is clearly an industry leader. It's had some significant declines on its share price because it has missed numbers. But when you look at where it currently sits at the moment, I think you probably make good money in that type of stock over a 1 to 5 year view. So it's perhaps going back to your industry leaders, your favorite high quality stocks, and you're not going to manage to catch the bottom of the market with these things. And I would suspect we're actually relatively close to the lows. Maybe there's another 10% downside. And so buying your sort of favored names, perhaps over what will be quite a volatile summer, might be the right approach.
Adrian, by the way, it's Nikunj's birthday today, and I know you want to wish him, but on his birthday, do you want to also give some stock-specific ideas for all of us and our viewers?
So, you were talking about in the introduction about HDFC, and that's a stock that I do own. It's a very strong franchise. Clearly, we've had some corporate action, and it's now one entity rather than two very distinct entities. Throughout the world, when I look at the banks, what I see is banks that the well-run banks are still generating very high return on assets, high return on capital employed. And remember that the banks, okay, we might be facing a more adverse economic outlook, but hang on, stop a minute. We've just been through a pandemic. We had the biggest ever demand shock I've experienced when the world went into lockdown in 2020, and we had waves of the coronavirus causing lockdowns to reoccur in 2021. Coming into this year, we're all focused on the Omicron variant, and there were many countries that imposed flight bans. I live in Hong Kong. Many countries, airlines were not allowed to come from those countries. There were 3 weeks quarantine required. And so I think that banks have been oversold globally, and that people are sort of behaving as if we haven't seen a difficult economic environment for a while. They're behaving as if we're at the end of a cycle, a protracted expansion in economic growth, which clearly is not the case, because just let's reflect on how 2021 and 2021 were with the impact of this pandemic. So I like financials. I think with what's happened in the US market's impression of the world, we've gone from an opening up trade to an inflation fear, a very rapid rise in US bond yields, in expectations for what the Fed will do. And now we're into the phase where now we're much more concerned about growth. And as we become more concerned about growth, we're beginning to see 10-year bond yields coming off. And there's been quite a meaningful decline in the last week. And to me, that suggests that you should be looking back towards some of your favored growth names that have been very hard hit by the rapid rise in interest rates. And I think that fits in well with the question you were asking me earlier. This is a time where, that all stocks get hit hard, and you get an opportunity to pick up some of those growth names. So your top quality bank in India would clearly be HDFC Bank. But I would also be interested in some of the IT names. And if you look at, so let's say, Tech Mahindra sits in the Nifty as probably the worst performer, I think the biggest drag on the index. And we've seen a lot of pain in the tech sector as it has derated. In some cases, that derating was very valid, but I suspect it's gone a little bit too far. And I'm going to fear of running off on different tangents here, but when I look at my experience when I was covering Indian equities and also looking at global equities in the early 2000s, and we had a big derating in the tech space. When I look at the NASDAQ index back in 2000 through to 2002, there are really only sort of 3 big companies that are still in the index: Intel, Microsoft, and Cisco. And all those stocks are trading at PE multiples that are less than when the derating stopped in 2002. And actually, in the case of Cisco and Intel, significantly less. And so, my sense is that we've done this incredibly rapidly. It's not this protracted 2-year bear market that we had in the US. I think actually we'll be back into a recovering market as we finish the third quarter. And I think there's a good chance that indices may end up finishing the year closer to flat rather than down significantly as they are at the moment.
Okay, Adrian, so that's the word coming in on financials like HDFC Bank, as well as IT names is something that you keep on your radar. But overall, how are you looking at some of those defensive bets, the likes of consumer staples, etc., in the wake of inflation?
So I would be very cautious about these. There's been a rotation into more defensive names, but I would question how defensive they are. We've seen the experience of some of the announcements from US consumer staples in which their impact from inflation has been more negative. Their problems when having lack of supply of some key components, but maybe having too much inventory of other products. So my view is if you feel like you need to be defensive, then be in cash, but don't buy an expensive consumer staple, because there's a good chance that you get disturbed by what happens with the margins in this environment where currencies are moving rapidly, commodity prices are moving rapidly, and there are supply chain issues.
Adrian, so what will it take for you to say, I like Indian food, but I also like Indian stocks?
So I think for India to look more attractive, there are a couple of factors we need. First of all, globally for equities, we need the volatility on US bonds to come down, so US treasuries. I think that's very important in order to reduce the volatility that we're seeing in risk assets. If that's happening at a time where we're beginning to see the ongoing evidence that the US economy is softening a little bit, the labor market is softening, and inflationary pressures are coming off, then I think that'll allow global risk assets to stabilize. For India, it's also important that the oil price starts to come off. And one thing I think has been incredibly frustrating is even though people's growth expectations have moderated for the global economy, we've still got an oil price that remains stubbornly high. And I think the final thing, I suppose, is what's happening with the China trade. At the moment, we have Xi Jinping, the president of China, continuing to make speeches about zero COVID policy, which face value seem to be very bearish, or they are very bearish. But at the same time on the ground, and this was evidence in the PMI data, it appears that the policy is easing. So we might be in a situation where the rhetoric remains negative, but what's going on the ground is more positive. And if Chinese equities, after underperforming for so long, continue the recovery that's been in place for the last month, I think that is going to drag emerging market capital out of other markets, and that'll be a bit of an issue for India as well.
Adrian, they say once bitten, twice shy. Wouldn't that be an experience of a Chinese investor?
Yes, I mean, look, this is climbing a wall of worry, which is typically what happens at the end of the bear market. And so, yes, I personally, don't have a clear picture of what the Chinese government's after with regards to zero COVID. There is some evidence, though, that they have been easing the regulation on the tech space in China, and the Chinese indices is dominated by the tech-enabled businesses like your Alibabas, your JD.coms, your Tencents, etc. And we've had a combination of, China's zero COVID. We've had very adverse regulatory environment for these major companies, which has caused this significant derating. There is evidence in, for instance, Tencent, where the regulator has approved a lot more online games and their ability to generate revenue from that. There might be a resolution to the situation around Didi, the ride-hailing app that is delisting from the US market. So we do seem to be getting some indication that the regulatory environment is becoming easier for the tech space after being very, very significant headwind. Now the big question is, can China somehow move in the direction that we've seen the rest of the world move in, which is to accept that COVID is endemic and that we really can't maintain these pandemic control measures, which is pretty much what the rest of the world's got to. And China is now standing out in continuing to promote a strategy where they're trying to eradicate a disease, which is extremely difficult.
All right, Adrian, really appreciate your time. So glad you could join us, and certainly hope to see much more of you going forward.